All right, guys. Let's look at soybean meal and to see why I took this trade. Right? Okay. So you guys know that I trade with the CO2 report, and I want to make this very simple and straight to the point. So I use something called the CO2 index. Okay. So what I always look for, if you remember in my previous voice recording that I made to explain to you guys about what the CO2 report is. If you have not listened to that, please go and listen to it again to kind of understand what we are doing here. So the first thing you remember, I told you guys that I always look for scenarios where commercials are doing one thing and retailers and fund managers are the opposite of that. Okay, so let's do a little experiment here. You see here, by the way, the blue line is the commercials, green line is the retailers or dump money, people like you and I. Then you have the red line, which is the large speculators or non-commercials in the COT. Now, as you guys know, I told you before that all I do is I try to follow what smart money are doing, right? So I don't try to reinvent the wheel. I don't try to predict markets or something like that. I just try to look at what commercials are doing and I follow them. That's all, right? They are the smartest guys. They are almost always right. They are right a lot of times. So I don't really need to be a smart guy to trade in a market. I just need to follow what the commercials are doing. That's just how I trade as my strategy, right? So let's do some experiments. You see here, commercials, which is a blue line, they are bullish. Anytime they are touching this yellow line up here, it means they are bullish. 3 year extreme, that's they are more bullish than they have been in the last 3 years. And if you see the green line here, that's retailers, and the red line, um, fund managers, which means they are bearish, more bearish than they have been in the last 3 years. And you can see here, commercials are buying, and what are retailers doing? Retailers are selling. Why? Because they dump money, right? Commercials are doing the opposite. Retailers, they are jumping into the market because the market is dumping. Like, oh, I need to enter the market and sell, and they are selling at market bottoms, right? Meanwhile, the commercials are doing the exact opposite of what they are doing, and this is the kind of scenario you want to see in the market when you are using the COT report, right? So in this scenario here now, you see that commercials are bullish, retailers are bearish, fund managers are bearish. And what do you think is going to happen? Just look at your chart. The market rallies, right? Let's look at another scenario again. Let's see here. Here you see, no, this is not okay. Let's see here. Yeah, you see here, commercials are bearish. What are retailers doing? They are bullish. What are fund managers doing? They are bullish. Why? The market is rallying. The markets are at the top. They are still buying. Oh, the market is rallying. I need to keep buying. I need to keep buying. But what are commercials doing? The smart money. They are selling. And what do you think happens? Look here, the market dumps. And guys, remember, we're looking at a weekly chart. So all these candles you are seeing here, they are weeks of market dumping. Okay, let's look at another scenario here where smart money or commercials are bearish, and what our retailers and fund managers are doing, they are bullish. What is going to happen? The market is going to dump, right? Now look at another scenario here where fund managers are bullish, commercials are bearish, retailers are bearish. Look at up here. What is going to happen after? Market is going to dump, right? Let's look at another scenario where smart money or commercials, they are bullish, while retailers are, well, they are not extremely bearish here. So let's use another scenario. Okay, let's look at this scenario here where commercials are bearish, retailers are bullish, even though they are not that extremely bullish. But we see the market dumps for a few weeks, not that much, but it still dumps. So we can go on and on. Like I can do this over and over again for you, and you see, this is this is my edge, right? This is my edge. Once you know this and you have this information, this is your edge. Anytime you see a scenario where commercials are doing one thing and retailers are doing the other thing, That's your edge in the market, right? You know that you want to do the opposite of what retailers are doing, and you want to follow what commercials are doing. Okay, so in this scenario now, we're looking at soybean meal, right? This is a trade I am in. I bought this market, right? So why did I buy this market? Because this edge presented itself again. Look at the market. Commercials are bullish. What are retailers doing? They are bearish, extremely bearish, right? So if I see something like this in the market, I know that, oh, it's time to start looking for longs in this market, right? But that's not all I do, right? I have money tools actually that I look at, but the major ones are the COT report and COT index. Where we're looking at the COT index, and I have the seasonality tool and AI tool that kind of predicts markets based on like repeating patterns in the market. Then I have a valuation tool, but I don't use it for all markets. But that I use it too. It's not really that important on agriculture markets, but I was to show you guys how it works, right? So now we have a bias, right? We want to be bullish on this market. We have a bias already, and that bias is to be bullish. We want to buy this market, right? Okay. Now we have one confirmation that we want to buy this market. That's just one confirmation. I need three of these um, tools, or two of them, depending on the scenario, right, to be saying the same thing. Okay, so that was my first bias, that okay, I want to buy this market, but now I want to look at seasonality. Right, like, does seasonality agree with me? Like, during this time of the year, is it really a good time to buy this market? Because I don't just want to be buying the market, right? I want to buying it according to like the seasons. Like, is this a good time to buy this market? Let me use another color for this so that it will be brighter for you guys to see. Let's use this. Yeah, this is brighter. Right, so you can see what seasonality is predicting. Now we're looking at 15 years. That's the default settings here. We're looking at 15 years, which means we're looking at it. We're looking at 15 years backwards. Like, in the last 15 years, was a pattern that presents itself in this market. Like, in the last 15 years, was that obvious pattern that presents itself? And you can see here that in the last 15 years, this market tends to start rallying around, let's say, like the 7th of October, right? The market usually makes a bottom around. That's in the last 15 years. This thing happens every year, or almost every year in the last 15 years. That every time, almost every year in the last 15 years, the market starts to rally. It creates a bottom around the 7th of October, and it starts to rally up until around the 6th of February, right? The following year. So anytime you see these two lines on my chart, if you've ever been confused or wondering why I usually have two lines on my chart showing dates, is because I want to know the date of entry and the date of exit. Actually, if you look at this market, I can actually even hold it up until like even June, right? Because if you look at it, it's around June that the market will create a top and dump, right? But you don't want to get really greedy in the market. Once you see profit, you want to go out, because just because you see this happen doesn't mean for certain it's going to happen, right? It's a probabilistic market. Okay, so but I don't only look at 15 years. I usually look at 15, 10, and 5, and I make sure that all of them are green. You can look at in the last 10 years, this market still rallies around this time. Right? If you look at 5 years, now we're looking at the last 5 years, what really happens in this market using seasonal tendencies. You can see all the 3 years that I've looked at, 15, 10, and 5, they all agree. So now we have second confirmation, right? Remember, the first confirmation we saw is that commercials were bullish, retailers were bearish, and fundamentals were bearish. So we knew we wanted to buy. So we look at seasonality. Our seasonality agreed with us that okay, for sure this market is going to like buy, right? So the other two I was telling you guys about is valuation. Although this is not really that important on this market, it's mostly for maybe like other markets, like maybe like forex, maybe some metals like gold and stuff like that, and crude oil and all these things. But you can look at in this scenario now. Let's use 10-day cycle. We're looking at daily time frame. So you can see that even here, you can see that this market was undervalued to the dollar, right? yellow is gold, purple is treasury bonds, and green is dollar. So you can see that even here, I know these markets they are priced in the dollar too, right? So you can see that even here the market was undervalued to the dollar, right? Anytime the market is below this blue line, it's undervalued, right? You can see here the market was actually overvalued here, right? Which is it kind of like consolidated for some time and is dumping and is going to be undervalued for some time now. But this is not really important for this market. I'm just showing you guys to show you guys how it works, right? So now we know that we want to buy this market, okay? Fundamentally, we are bullish on this market, right? But now we have to look at technicals, right? Because I don't only look at, for me, fundamentals when I do my fundamental analysis is to have a directional bias, right? Once I have a directional bias, technicals to me is just an entry tool, you could say, like a timing tool, because just because you know the direction of the market doesn't mean you just start buying randomly, right? You actually have to look at technicals to kind of like know when to buy the market. And for me, I look at supply and demand. That's what I trade, right? So in this scenario, this market was around here. So what I did, if you look at this market from like from a holistic view, right, you can see that you could say it's it's kind of like a consolidating market long term, right? Because you see that it's just been like up down up down up down. But if you want to look at, let's say from here, you could even say, okay, this market is like a bearish market because it's been making lower lows and lower highs and stuff like that. Okay, so in this scenario now, for me, I looked at this market. I knew I wanted to buy this market, right? So I looked at to my left, and guys, I trade supply and demand. So for me, this was like the most obvious supply and demand zone I saw here. Remember, I want to buy this market. So anytime I want to buy a market, I look for the nearest demand to the price, to current price, and then price was still dumping. I think it was around here or something. I don't know. So I saw this demand, and this was the most obvious demand I knew, a very powerful demand. You can see there was a consolidation here, and then you can see this movement, this huge movement. Weekly candles, guys, this huge movement to the upside. No red candle here. It was a very strong demand. Um, this can only be big institutions or commercials moving the market like this. You and I, retailers with small money, we can't move the market. So when you see a market like this, you know that, oh, this is a powerful market. And remember, this is a demand from about 2016, right? But it's a very powerful demand. So when I saw this demand zone, I marked my demand zone. I use the Fibonacci tool to do this, and I always use minus 33% for my stop loss. So when I saw this, I knew that this was a good demand to buy from. Right? And I always have an opposing. For me, I don't always like to hold markets that long, right? If I see profit like 1 to 3, 1 to 4, depending on the market, on what I see in the market, I usually get out, right? Just because I have an exit date of February doesn't mean I'm going to hold the market to February. It depends, right? So most times I look for is like an opposing zone. So for example, this is my demand here that we looked for from 2016. Right now, I look for a supply zone where I want to get out, because if this market reaches a supply zone, there's a tendency that that supply zone is going to push the market down again, right? And I'm not really interested in that. I just want to get out of the market with the profit I have. So you can see that this is a supply zone here. So this is my exit, right? Once the market reaches the supply zone, I want to get out of the market, right? So I have a supply zone that I drew here as my place of exit. And then this is I also do this with the Fibonacci tool, just for knowing when the market is in a discount or premium. So for me, once the market is in this blue line, with the blue side we can see here, that means the market is in a discount, right? And you can see that from this supply to this demand, this was actually a discount. From where I bought it, it was very cheap. Like you see here now, the market is like in a neutral zone or equilibrium. So I would not really be interested in taking additional positions here. And once the market comes red up here, for me that's um, premium or expensive, right? So now remember, guys, we're looking at technicals now. So once I saw all of this, I already knew that okay, I'm going to buy the market from here. So I just put my entry here. You can see my entry around here, stop loss here, take profit here. That's just it, guys. As simple as that. It's not complicated. So that was it. The market triggered and it's been rallying since then. You can see we had 1, 2, 3 weeks of straight up rally to the upside. And what you're seeing here now is consolidation. The market has been consolidating for 1, 2, 3, 4 months now. Right. So the market is just consolidating after moving, and I expect it to continue the move up to the upside and hit the TP. So that's just it, guys.